right. Thanks everybody for tuning in. This is our monthly update on what's going on in the Simplify Managed Futures ETF, ticker CTA, or as we like to call it, what's trending in CTA. I'm joined by Charlie Magera again today, as always, CIO of Altus Partners, who is the futures advisor on the strategy. And per usual, we're going to run through a little bit of the prior month's performance, positioning. We'll talk about what's going on in trend markets. We'll talk about a little bit of year-to-date performance as well to give some context. But no shortage of interesting things going on in a market where we're constantly evolving and adapting to where the trends are. So with that being said, I will share my screen and we will talk about performance. So one thing I think it's always helpful to put into context is the objective of our strategy and really thinking about the benefits of including trend following alongside your stocks and bonds in a portfolio is to have diversification. We've had a low and even negative correlation to both stocks and bonds since we launched back in 2022, and you'll see that here on the slide. Negative correlation of about 0.2 to the S&P 500 and negative 0.4 to the US aggregate bond index. And as a reminder, CTA invests in both North America commodities as well as interest rate futures. And with that being said, despite our commodity exposure, we are still diversified. And I say this, if you do have strategic commodity exposure in your portfolio, there is still a diversification benefit of having this alongside. In addition to having the objective of diversification to help smooth overall portfolio volatility for your stock bond mandates, another added benefit of this strategy is the ability to produce attractive absolute return. And we're quite proud of our since inception performance. You see here about 9.47 or 9.5% annualized total return of the strategy. And then the number you see just below that is our excess return versus the benchmark. And that is a very big number. Trend following has seen quite a few headwinds over the last several years. 2022 was a strong year for the market broadly, but there's been a lot of hiccups since. And so we're really proud of the long-term outperformance and excess return that we've delivered versus the SocGen CTA index, which is our official benchmark. And again, as a reminder, the markets that we're trading in are listed here: North America rates, as well as commodities. This is a predefined set of markets. So any of the markets that you would see traded in the portfolio on any given day are those that are listed here. We have the ability to go long and short across all of these markets. And much of this is driven by our model that Altus Partners created and maintains for us. And I think this visual is also really important, going back to that primary objective of diversification against stocks, bonds. The white line is our strategy CTA, plotted back to the inception in 2022 against a 60-40 portfolio, which is the orange line. And the importance, in my opinion, is less so about who's outperforming. I think Charlie would disagree. He wants us to always outperform, but it's really the ebb and the flow. It's to showcase how these diversify. And when stock bond portfolio sells off, CTA has historically been the ballast in your portfolio. And I think this is super important, especially with the volatility that we've seen in bonds as of late and the importance of having more ballast embedded within the portfolio. So let's jump right in then to performance, which is why many of you have tuned in today. We have performance here through the end of August, and we have trailing 1 year and 3 year from Morningstar on the left. We have a 4-star Morningstar rating. Percentile ranking for 1 year is still in the top decile, just outside of that top decile for a 3-year trailing. So again, proud of our performance that we've delivered with attractive outperformance versus the benchmark and many of our peers. And then what we do want to start talking about, which I think is important, is some of that attribution. So it's been a pretty wild ride this year, a lot of volatility, especially in the second quarter. The quarter to date for 3Q has been pretty strong, but it's not without some bouts of vol. So we talked about in last month's update, which you can always go back and watch, some of the sell-off due to copper at the very end of July. And so for the August full month period, we did see a little bit of volatility in that first day, driven by what we're actually seeing today as we record this on September 5th, just being caught off sides on some of the rate volatility in the front end. We had another employment report as we did on August 1st. which caused some of the backup in the front end of the curve, and we've been short. I'll let Charlie speak to that positioning here in a moment. But despite that one day sell off, we've really had a strong month in August as well. So, strong month of July, strong month in August, and some good outperformance versus the benchmark as well. So maybe with that, I will pause. I'll hand it over to Charlie here to get into some of the more nuanced positioning and what's been driving year to date as well as the prior month's performance. But you'll see here on the far left, month to date, our NAV return, really attractive, positive absolute return across the month to date, quarter to date, and year to date period. And much of this has been driven by the commodity exposure. So it's been a challenging environment for rates. But commodities have led the charge. And so maybe with that, Charlie, fill us in. What's driving some of this performance?
Sure. Yeah. So as you can see, it's kind of a tale of two cities across asset classes within the month, which is rates didn't do so great and commodities were at a pretty strong performance. Um, and on the interest rate side, it all kind of happened pretty fast, actually. And with the payroll report on August 1st, which was a Friday, the July payroll report, we had a sort of shocking underperformance of the labor market in the US. And the market's heavily re-rated interest rate. And as a result, our short positions on front end SOFR contracts and 2 and 10 year treasuries, they just didn't perform very well. And again, that's the market re-rating growth expectations a little lower in the face of soft labor numbers and rating monetary stimulus. Now, I think there's a lot of open questions around that. The most important of which is we're still seeing some inflationary pressure. And if that inflationary pressure is supply side, it's not obvious that monetary policy intervention, which is really designed to use the credit channel to transmit demand side stimulus, will matter. But that said, the administration has a particularly strong view that the Fed should be a lot easier than they are. And whether or not demand side stimulus is the right cure for a supply side shock induced by tariffs that's causing a bit of inflationary pressure is sort of beside the point. The market's not really that focused on it. What the market's focused on is the independence of the Fed as expressed through what degree of cut is going to happen. Now, the challenge that we have is we've been short interest rates in CTA. And the reason is that, number one, the curve is inverted still. And so there are attractive carry dynamics, especially in the sort of 2 and 3 year bucket of the curve versus overnight funding rates. There's curve roll up on yields. There's some carry to be made by being short. But also, and interestingly, the strength in U.S. equity markets, which is sort of saying it's a kind of a pro-growth signal. If you look at least into longer-term historic data, when the market is behaving like this, it should make you a bit more bearish on front-end interest rates because it's sort of like, well, it seems okay, and the policymakers should be kind of cooling it off a little bit. But that's definitely not what's happening in terms of what the market expects. And it really is a political dialogue. So it's sort of an outlier period. And the soft labor data was a challenge. Interestingly, today as we record, it's also Friday on non-farm payrolls day. And again, we have surprisingly soft labor data and the front end position, which is driven by the same thing, is basically
Maybe we
still.
should stop recording this on employment day.
Yeah, perhaps. But we shall see. We shall see. And but that's the interest rate story in a nutshell. And we are short rates, and it's not as much a trend position as it is an intermarket driven and carry dynamic driven trade.
And I think that's
we think a lot of the easy is already priced, basically.
I think that's super important as it relates to differentiators of our investment process. Is the model is not just a simplistic trend model. It is looking at other factors and indicators, as Charlie just mentioned. So if you guys have questions on that, definitely reach out. We have a lot of information we can share on our investment process and how we derive these signals. So maybe another comment you can make, Charlie, is just on the cattle position. That's obviously been a really strong tailwind for the portfolio.
Yeah, and then on the commodity side, we're kind of the other way. Sorry, it's worth one last sort of comment on rates, which is the trend indicators are still, at least our trend indicators, I can't speak for everybody else, we're still mildly bearish on interest rates from bond prices, and i.e. interest rates higher, bond prices lower. We still have a very slight bearish bias on our trend indicator, but it's not very strong. So that's rates. On the commodity side, it's been a totally different game. And the story of the month is the continued very strong uptrend in the cattle markets, live cattle and feeder cattle, and that's really a supply side story. Demand is strong, which is great, but there's a drought that's driving reduction in pasture land, and the herd is like the smallest it's been, I think, since 1973. I think I read on a CME piece out there recently. So it's a supply side story, and the market is trying to find an equilibrium. And we'll see how much further this one can go. I definitely think some positioning has gotten a bit more crowded in it, in the sense that you could see when interest rates gapped on the payroll report at the beginning of August, there was a sort of related de-risking. It felt like across momentum trades, all over the system, and that position pulled back. So I think there's still some market length in that, let's say, but
I think one thing that's
yes, but it seems like a promising trend position. The signal is still reasonably strong.
I think one thing that's really important, taking this to a 30,000 foot view, is the question around like, why does trend or manage future strategies, like, how do they actually provide diversification? Why are they low or anti-correlated to stocks, bonds? And I think it's really finding these sources of risk and return in a portfolio that are not tied to economic risk. And to your point, Charlie, is thinking about the supply demand mismatch in cattle, for instance. There could be some indirect spillover effects from broader market sell-offs in momentum trades, as you highlight, but the supply demand within the cattle market is not necessarily tied to economic risk in the way that stocks and bonds are on a daily basis. And so that differentiated source of return for the portfolio, I think, is a prime example, one that's provided performance tailwinds for this strategy and really shows the benefit of having this in a portfolio to actually
Yeah,
diversify.
I think if you're committing your capital, you want to be diversified on a lot of different themes and ideas, and get paid for your capital to be used as getting paid for your capital to be used as working capital in the commodity supply chain, and helping it find the new level to equilibrate supply and demand. If that doesn't have much to do with the financial stuff around growth and inflation that we kind of talk about every day in normal financial markets, then it is a good diversifier. And we've definitely seen that, and it definitely accrued to the benefit of the strategy in August, which is great.
Yep.
So,
That's
yeah,
great. Awesome. Well, appreciate those comments. I think another helpful visual is really just thinking about how dynamic the exposure is within trend following, the ability to go long and short, as I mentioned at the onset, but how quickly we're moving from being long, short, dialing up exposure, dialing down exposure based on volatility in the marketplace. And I would say the biggest difference from month over month, or what we've seen transpire over the last 2 months roughly, is this continued momentum in positioning as it relates to being short the front end of the US interest rate, or the US curve for interest rates. And so you'll see that we've kind of come to an extreme position in being short rates. Some of that's been pared back in the last few days. But I think just from, again, 30,000 foot view, thinking about how we're positioned. And we do like to delineate between the commodity and the rates exposure, because of course commodities have higher volatility. So looking at the dynamism of those exposures separately, I think is helpful.
yeah,
This, I won't go into too much detail, and this slide deck is available. Please reach out if you'd like these slides afterwards. But just kind of showing how we've moved across various futures markets over time, all the way back to since inception, and kind of where we're positioned as of the end of August, that you'll see here. So super helpful. And then just some more detail on how positioning has transpired over the quarter to date period across various markets. But you can see again that concentration in cattle, both live and feeder, some of that copper and silver position, and gold has started to pick up in the last couple weeks of August. So that could continue to kind of rise to the ranks from a notional exposure. So be on the lookout when we do the end of September update as well. And then no surprises here. Most of the rates exposure has been concentrated in the front end of the US curve for all the reasons that Charlie just mentioned. So I'll conclude today's update with just a couple thoughts I have. Coming into September, we typically see, seasonally speaking, pullback in markets. There's a lot of volatility ahead of us. Today's data print was one of those. Markets are reacting favorably because there's more policy support coming into the market. We have some inflation data coming out in the next week or two, and then of course the Fed decision. So a lot of things I would say that could be a catalyst for either continued upside or, of course, downside in the markets. And so having your diversifiers, having low and anti-correlated sources of risk and return, because if and when, significant pullback happens in the markets, we tend to not see them coming. So this is just a visual to think about, like in the past, how the asset class broadly has been a bit of that ballast when stocks and bonds do not deliver for the portfolio. So Charlie, thank you for your time today. Thank you to everybody who tuned in, and please reach out to your Simplify rep if you would like more information or insight.